Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
All right. Ready to up your real estate investment game?
Always ready.
Smart move. Today, we're diving into an article called 9 Decision Metrics for Evaluating a Real Estate Investment.
Ooh, sounds interesting.
So we can all analyze deals like seasoned pros, get ready to make those numbers work for you.
Yeah, I really like how this article, it gives us a framework, really, that we can use on any property.
Oh, nice.
Yeah, it's like a universal translator for real estate.
I like that.
Yeah, to compare different opportunities.
Okay, yeah.
And make good decisions.
So it starts with something called yields.
Right.
Basically, how much return you can expect on your investment.
Yes.
Like squeezing all the juice out of your real estate orange.
Exactly. And it's important to know the difference between, gross yield and net yield.
Okay, yeah.
Gross yield is just that quick snapshot of rental income before expenses.
Right.
Net yield is where the real story unfolds.
Ooh, I like that.
Yeah, it factors in all the costs, taxes, maintenance, insurance premiums. Net yield is the true measure of how much money's actually landing in your pocket.
Okay, so they give us a handy formula here to calculate it.
Oh, good.
Net annual rental income divided by the purchase price, multiplied by 100. And that gives you your percent yield.
Okay, yeah.
So let's say we have a property for $1,000, and it brings in $123,000 in net annual rental income.
All right.
That's a 12.3% yield.
Not bad.
Not bad at all.
And the really cool thing is you can actually flip that formula and work backwards. So say you have a specific yield in mind.
Okay, yeah.
You can actually calculate the maximum price you should pay to hit that target.
Okay, that makes sense. Like a roadmap.
Yeah.
Yeah, the article really got me excited about this. Capitalization rate, or cap rate for short.
Right.
This ratio connects a property's value to its potential income.
Yeah. A higher cap rate usually means a better return on your investment. And we calculate that by dividing the net operating income, or NOI,
Great.
by the market value of the property.
Okay, so they give a good example here. A property with an $80,000 NOI with a market value of $1,000, that's an 8% cap rate.
Okay.
But even if the cap rate stays the same, you can increase rents over time to boost the property's value.
Absolutely. Like, let's stick with that $1,000 property, right?
Okay.
Imagine just a 4% annual rental increase over 10 years.
Okay, yeah.
That can lead to a value jump of over $400,000.
Oh, wow.
Yeah, it really shows the power of compounding growth.
So this is where understanding cap rates across different property types and locations becomes super important.
Yes, definitely.
Like a low-risk office building in a prime location might have a lower cap rate than, say, a multifamily property in an emerging neighborhood.
Right.
So balancing risk and reward based on your investment strategy.
Exactly. Now we can't forget about those pesky outgoings that can chip away at your profits.
The sneaky costs of owning a property.
Yeah. So we're talking about, council rates, land tax, body corp fees.
Right.
If it's strata, water rates, insurance, and those ever-present maintenance and repairs.
Yeah, you got to factor those in.
Absolutely. And this is also where understanding lease agreements becomes important, right?
Yeah.
Who's responsible for what?
Right.
The fine print matters.
Very important.
Clearly outlining landlord and tenant responsibilities in the lease can make all the difference.
All right, so let's talk about something that can make tax season a bit brighter.
Oh, good.
Depreciation.
Yes.
It's not just about things getting old, right? It can actually put money back in your pocket.
It can. Depreciation allows you to deduct a portion of the property's value each year to account for wear and tear. It's a fantastic tax benefit.
So the article breaks it down into 2 main categories.
Okay.
Capital works, that's the building itself, and then equipment, ovens, air conditioners, those fancy light fixtures.
Right. Now keep in mind the ATO, has specific rules regarding what can and can't be claimed.
Right, yeah.
Always wise to consult with a qualified tax professional.
Oh, absolutely.
Yeah, and speaking of wise moves, the article really stresses getting a tax depreciation schedule, or TDS, right after you buy a property.
Okay.
Helps you maximize those valuable tax benefits.
No, while tax benefits are great,
Yeah.
it shouldn't be the sole reason you buy a property.
No, no, no.
The investment fundamentals need to be solid.
Absolutely.
Depreciation's like the cherry on top.
Exactly.
All right, let's get to the heart of it all. Cash flow.
Yes.
This is the money you're actually making from the property.
Right. Cash flow is simply the money coming in from rent.
Right.
Minus all those costs we've been talking about.
Okay.
And there's two types of cash flow, pre-tax and post-tax.
Right.
Depreciation and tax benefits come into play when you're calculating post-tax cash flow.
Okay, so the article has this helpful example. Using a property with $10,000 monthly rent and some specific outgoings, and they actually calculate both pre-tax and post-tax cash flow. Now, there's this really interesting concept here, net present value,
Right.
or NPV.
NPV, yeah.
It helps us compare investments with different cash flows over different time periods.
It does, because $1 today is worth more than $1 tomorrow.
Right, yeah.
So NTV helps us see which investment is more valuable over the long term.
Okay, I like that.
Yeah.
Like a financial time machine.
It is.
All right, let's move on to net operating income, or NOI.
All right.
This basically tells you how much money the property is generating
Yeah.
after subtracting operating expenses.
Yes. The formula is pretty simple. Gross income minus operating expenses equals NOI.
Gotcha.
So, for example, if a property brings in $140,000 in gross income, but it has $40,000 in operating expenses, its NOI would be $100,000.
Okay, but watch out for a negative NOI.
Right.
That means you're losing money on the property.
Yeah, negative NOI means your operating expenses are exceeding your revenue.
Red flag.
Yes, definitely a sign to investigate further.
Time to shift focus to the long game.
Let's talk about capital growth.
Capital growth, all right.
Seeing those gains over time.
Yeah, capital growth is the increase in a property's value over time.
Okay.
It's influenced by population growth, economic conditions, infrastructure development.
So the article mentioned something really interesting, a property clock.
Oh, yeah.
This visual helps you understand the different phases of growth, maturity, decline, and recovery,
Right.
like a compass guiding you.
Yeah, it's a fantastic tool for recognizing patterns.
So remember that $1,000 property from before?
Yes.
They revisited it in the article to show how those small rental increases can impact capital growth over time.
Yeah,
Really powerful.
it is.
Okay, before we get carried away with profits, let's talk about purchasing costs.
All right.
More than just the sticker price.
Yeah, it's all the upfront expenses that come with buying the property.
Yeah, like legal fees, mortgage fees, stamp duty, inspections.
Taxes, valuation costs.
The list goes on.
It does. They break down these costs in the article and even provide an example of how to calculate a realistic purchasing budget.
That's helpful.
Yeah.
It's all about having a clear understanding of your financial capacity.
Okay, last metric. Loan-to-value ratio, or LTV.
All right.
The percentage of the property's value that you're financing with a loan.
Right.
Higher the LTV, the higher the risk.
Exactly.
Imagine if the market takes a dip and your property value drops.
Ooh, yeah.
You could owe more on the loan than the property's worth.
Oh, good.
So they use an example here.
Yeah.
$100,000 mortgage on a $200,000 property. It's a 50% LTV.
Okay.
And there are ways to lower that LTV
Yeah.
and reduce your risk.
Yeah, things like paying down your mortgage faster, opting for a smaller loan amount, or investing in higher quality properties.
Okay, before we wrap up this part, we have to acknowledge that real estate valuation isn't always straightforward.
No, it's not. It's like navigating a jungle sometimes.
Right.
You've got your compass and your map, but there are always unexpected turns.
So the article dives into 3 key challenges.
Yeah.
Data availability,
Okay.
predicting future growth,
Right.
and unpredictable economic factors.
Yes.
So how do we navigate all of this and make smart decisions?
Well, I think one of the most important things is due diligence.
Right.
Research.
Yeah.
The numbers are important, but the story behind the numbers really matters.
Right.
It's about understanding the market, the local economy, and really scrutinizing those property details.
Okay, awesome.
Yeah.
We'll dive deeper into this and discuss some actionable strategies next time. Welcome back. Ready to unravel more real estate mysteries.
Always.
We left off talking about those challenges of valuation.
Right.
Even with all the metrics, it's not always clear-cut, is it?
No, it's not. It's like navigating a jungle sometimes.
Wow.
You have your compass and map, but there are always unexpected twists and turns.
Yeah. So the article dives into 3 key challenges.
Okay.
Data availability,
Right.
predicting future growth,
Yeah.
and those unpredictable economic factors.
Yes.
Let's start with data. It seems obvious, right? You need good data to make good decisions.
Yes, you do.
What are the pitfalls there?
Imagine trying to assemble a puzzle without all the pieces.
Okay, yeah.
That's what it's like to evaluate a property without good data.
Right.
Information on property values, rental rates, market trends. It all needs to be accurate and up to date.
Okay.
Relying on outdated or incomplete data can lead to some very expensive mistakes.
The article actually recommended checking out 10 data collection tips for real estate investors.
Oh, yeah, good one.
Sounds like a must-read.
Absolutely. Now, the second challenge, predicting future growth, that's where things get really tricky. It's like trying to read tea leaves.
Yeah, it's impossible to predict the future.
Yeah.
With 100% certainty. But we need to at least make educated guesses.
Yes, you do. You gather clues. Think of it like being a detective.
Okay, I like that.
You piece together evidence to paint a picture of what might happen.
Right.
Population growth, economic conditions, interest rates, government policies, these all play a role.
And then you have those unpredictable economic events
Yeah.
that can throw a wrench in everything.
Yeah, those are the wild cards. You know, a sudden rise in interest rates, a global pandemic, those
Yeah.
things can turn the market upside down.
Yeah. So with all these potential obstacles,
Mhm.
how do we navigate these murky waters and make smart decisions?
It all boils down to thorough research and due diligence.
Right.
The numbers are important, but it's the story behind the numbers that truly matters.
So understanding the market,
Yes,
really digging into those local nuances,
exactly.
looking at the property details.
Organizing them.
Yeah.
Yeah,
Are there planned developments that could impact values?
right.
What's the population growth like?
Exactly. These are the things that will inform your decisions.
So it sounds like we need to stay informed
Yes,
and be prepared to adapt.
absolutely. The market's constantly evolving.
And don't be afraid to seek expert advice.
Oh, absolutely not. Talking to experienced real estate agents,
Yeah.
property managers, financial advisors, that can be invaluable.
Yeah, they've seen it all.
They have.
So we've talked about the metrics
Right.
and the obstacles.
Yes.
How do we apply all of this when we're evaluating properties?
So imagine you're comparing 2 properties, property A and property B.
Yeah.
Similar size, similar location,
Okay.
but different asking prices, different potential rental incomes.
Gotcha. So where do we start?
We'd calculate the yield.
Okay.
Remember, net annual rental income divided by the purchase price.
Right.
That gives us that snapshot of return on investment.
And we're talking net yield here.
Net yield, exactly. The
Yeah.
real story.
Okay. What's next?
Then we look at the cap rate for each property
Okay.
to see their value relative to their income potential.
Right. Higher cap rate, better return.
Generally, yes. But remember, context is important.
Yeah.
And don't forget to analyze those outgoings.
The hidden fees.
Yes. Property taxes, insurance, maintenance costs.
Yeah. Those can really add up.
They can.
Okay. So then we look at the potential for growth.
Right. Is it an up-and-coming neighborhood?
Right.
Any planned developments? Infrastructure improvements?
Those kinds of things.
Exactly.
And of course, financing. We talked about the loan-to-value ratio.
Yes. Interest rates, loan terms, your down payment.
Then putting together a puzzle.
It is. Each piece represents a different aspect of the investment.
Right.
And you need to fit them all together to see the full picture.
Okay. I like that. Any final thoughts?
The key takeaway is this. Knowledge is power when it comes to real estate investing.
Okay.
Understanding these metrics, doing your due diligence, seeking expert advice when you need it,
Right.
you can navigate the market with more confidence.
Okay, great. We've covered a lot.
We have.
We'll be back shortly to wrap up this deep dive and leave you with some things to think about as you continue your real estate journey. All right, welcome back. We're at the finish line of our real estate metrics deep dive.
Time to put all this knowledge into action.
So we started with yields and cap rates,
Right.
explored those sneaky outgoings, uncovered depreciation,
Yeah.
and even looked at some obstacles investors face.
It's all connected.
It is, right. It's not about understanding these things separately. It's about seeing the big picture.
Exactly. Like pieces of a puzzle.
So if we were to make a cheat sheet for our listeners,
Mm-hmm.
What are the top 3 things they should remember?
Okay, well, first, every property, no matter how complex, can be evaluated using these metrics.
Okay.
It's about consistency, being able to compare and make clear decisions.
I like that. Number 2.
Number 2, real estate investing is not just about the numbers.
Right.
It's the story behind them. Market trends, the local economy, the specifics of the property.
It's like being a detective, right?
Exactly. Gather the clues, make an informed decision.
And number 3,
Don't be afraid to ask for help.
expert advice.
Yes. Talk to agents, property managers, advisors.
People have seen it all.
Exactly. They can provide invaluable guidance.
So before we wrap up completely,
Yes.
I got to ask, given what we've talked about, what kind of property feels right for you?
That's a great question. It depends on individual goals and risk tolerance.
Exactly. Residential, commercial, something else, buy and hold, flipping.
So many options out there. Find what resonates with you.
The possibilities are endless.
Absolutely.
So there you have it. 9 metrics, tons of insights, and a world of opportunity in real estate.
We hope you feel empowered to approach investing with confidence.
Remember, knowledge is power.
It is. And with the right tools, you can achieve your goals.
So until next time, happy investing.